We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. I always say this, you can always go to the website to learn more about the team, Brian, Mark, Brad, all the guys at Decker Retirement. You just go to the website, deckerretirementplanning.com. But on that website, you can also find, under the heading of Safer Retirement Education, you can go, there are about 12 different things you can download, and it's really just stuff that's all for your information. There is a checklist challenge. Like there's 35 things. If you can check them all off, you're probably good to go for retirement. Where are you on that checklist challenge? There's a sample income plan. There's a 3 principles of retirement book. There's Brian's book on retirement, the Decker approach. That's just 4 of the 12 things you can download. So those are on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. Download any or all. It's all there for your information. And of course, if you want to talk with the team, you got questions, and Brian and Mark and the gang, they always cover a lot of ground on this show. You can always write down the number. It's 833-707-3030, 833-707-3030. There's no cost to you. But it is an opportunity for you to get some clarity. Well, hey, Brian, what you were talking about that day, how does that pertain to my situation? Because that's at the end of the day what we're concerned about. Well, our money lasts as long as we need it to. We don't care about our neighbors. It's about us. So this certainly, the planning process is about you. How can the team help? Can they? They don't know if they can until you reach out. So again, welcome, Brian and Mark. I'm glad you're here. We're going to be talking about what kind of topic? Valentine's Day weekend, and we're in that kind of time frame, and it's losing the spouse today, huh, Brian?
Yeah. So the single listeners won't have much to learn about here, but the married and the spouses that are married filing jointly, this is going to be a tax-focused, benefit-focused radio show today, and a lot of things that most people don't know. We have a very smart audience, I know, but this is worth taking out a piece of paper and a pen and jotting some notes. And Mark at Decker Retirement Planning he's our strongest tax and benefit CFP. So we have a good team today. So when a spouse passes, how do you protect your financial future? So Mark, let's start at the top. Financial planning for widowhood, and that affects women more than men because of longevity, but applies to everyone. There's many of our clients where the woman had passed before the man. But what are the immediate financial steps that need to be taken after the loss of a spouse? Like, let's start with Social Security.
Yeah, Brian, unfortunately, being in the financial planning world, we see this quite a bit. And, some of our best clients that we've had for decades, eventually one of them passes on. And that's really where we find a lot of value for our clients, is helping them navigate this process, moving from being married to now being a widow or a widower, and how do we transition into that phase of life. So you mentioned Social Security. Obviously, Social Security has its own rules and has its own programs and how it deals with these benefits that the surviving spouse has. So the first thing you want to do is notify them of the passing of the spouse. If you don't, and they continue to send you those monthly checks, then they penalize you later on, and they can come back and they can reclaim all of that income that they passed on to you as a lump sum. And that can be very painful if you're just trying to get through the month from a financial or from a money flow perspective. And then all of a sudden Social Security comes and says, you owe us thousands of dollars for benefits that we need to claw back. It can be really, really difficult. So make sure that you notify Social Security and also pensions. If your husband or your spouse had a pension coming to them, the same thing applies. You need to make sure that you notify them so they don't continue sending you that monthly income that you have coming in. When it comes to Social Security, we often have this discussion with our clients about timing. When is the right time to start taking benefits, and how does that work? Social Security has a unique feature to it in that upon the passing of the first spouse, the surviving spouse is entitled to the larger of the two benefits. So the smaller benefit goes away, but the larger benefit continues on to the surviving spouse, which is really beneficial.
Okay, Mark, let me jump in and add a couple of things, because you talked about immediately notifying Social Security the death of a spouse.
Mm-hmm.
If the payment was deposited for the month of the death, it has to be returned. So that gives you a time frame. The payment is got to be returned for the month of the death. The second thing is there's a small death benefit from Social Security. Guess how large, Mark? It's $255. It's small, but you don't want to miss it.
Right.
You're eligible if you were living together or already receiving spousal benefits. The deadline is 2 years after death. You can apply and get that $255. But the biggest one, Mark, is what you're mentioning. Make sure that the survivor receives the larger of the two benefits. You can't take both, but you take the larger of the two. Mark, what else on Social Security before we talk about other things?
You know, if you're getting to the phase of life where you're starting to think about turning on Social Security, you're starting to claim your benefit, taking into consideration the health and longevity of both you and your spouse is an important conversation, because that gets to questions around timing and optimal benefits and what this could look like if life expectancy is shorter or if life expectancy is longer. One thing that we do for all of our clients when they come in is we run a Social Security optimization report, and we have this conversation with all of our clients to build out their income plan and talk about, hey, well, when does it make sense to delay Social Security benefits, and when does it not make sense?
And Mark, I'm going to just hit some small things here. Check to see if the deceased had delayed retirement credits. So if your spouse delayed past full retirement age but hasn't started Social Security, those credits can transfer to you as a survivor, and they can significantly boost your payment. Now, when it comes to taxes, we want to make sure, because we are fiduciaries to our clients, let's check to see what your new bracket is, where your brackets are, because taking Social Security is going to be important. It's going to be important to know if you're going to be pushed into a higher bracket for taxes, and your Medicare, your IRMA surcharges. So you want to check to see those before you want to check to see where you stand on the tax bracket and IRMA Medicare surcharges before you decide on Social Security. Mark, anything else? I feel like we're hitting this pretty well.
You know, this question actually comes up quite a bit when it comes to filing taxes. Like, okay, let's say me and my wife, Melissa, let's say I pass away this year. How does Melissa file taxes next April? Well, the IRS allows her to file this year, 2026, as married filing jointly, because we were married during this year. And then for 2027 and 2028, so 2 years after I pass away, she files as what's called a qualifying widower. But starting in the third year, that's when she needs to start filing as single. And the tax brackets for single are much higher for single people. So if you're used to being in, let's say, an effective tax rate or a marginal tax rate of, let's say, 15 to 20%, well, it could be that you get bumped up to 22, 24% if you're single. So it's something that you got to be really aware of. How does your income situation impact you later on down the road?
Hey, Mark, I want to deviate a little bit from script here because you mentioned right away, let Social Security know that there's been the passing of your spouse or your significant other. And then the other thing that we talked about was, look and see where you're going to fall with taxes when it comes to your tax bracket and IRMA surcharges. But off script, get multiple death certificates, right? 10 to 15 certified copies. You're going to need them for banks, brokerage firms, insurance companies, real estate. You're going to need those. So that's another one high on the list, is get multiple death certificates.
Yeah.
Secure immediate cash flow. You've got to pay the bills. You've got to continue to pay the bills. Now, we at Decker Retirement Planning, we have retirement plans that show where the cash flow is coming. That is not interrupted when a client passes away. So if you're not with us, make sure that you secure immediate cash flow, that continues to pay your bills. Notify the employer, try to work out the final paycheck. Any accrued vacation and paid time off payouts, that can be significant. If you're with group life insurance, you've got to end that so that you start Medicare if you're 65 and older. Pension and survivor benefits, you've got to check to see if those are there and if they are, to pay out to you, the survivor. COBRA or retiree health coverage if you're under 65. Those are all really important. Another one, Mark, is contact the life insurance companies. So after filing claims properly, sometimes you can ask about partial advances if the processing is going to take a while, so that funds are not tied up and your income can continue. Decide where the proceeds, where they should be deposited. But the first 30 to 90 days is very, very important. Mark, before we go back on script, anything on those topics?
Just when I'm thinking about the situations that I've helped clients work through, the hardest part for the surviving spouse is consolidating a bunch of accounts that their deceased spouse had. If your deceased spouse had, an old 401k with $3,000 in it from his first employer, and he's got, maybe something with the county that he was contributing to, and he's got a bunch of IRAs and a bunch of other custodians, it's a nightmare for the surviving spouse to have to go and try to do all the paperwork and all the legwork to get these accounts updated and registered in their names and new beneficiaries and stuff. So if you're thinking, I want to make this as easy as possible on my spouse if something were to happen to me, it's so nice to have all of those accounts at one single custodian. Then you reduce the number of phone calls and emails and paperwork and online forms that you have to do just administratively. It's a blessing to your spouse to have your finances very clean and organized.
So at the end of the day, it really comes back to you having a plan. How do you want to leave things? And Brian, Mark, and the team at Decker Retirement are here to help you put that all together and have it make sense. We don't know when we're going to go. We don't know. Maybe we'll go at the same time. Maybe my dad passed away like 18 years ago and his wife's still alive. So you don't know how it's going to play out, but how are you going to leave things? You need a plan. You need a strategy. The team at Decker Retirement is here to help. 833-707-3030 if you'd like to have a conversation. 833-707-3030. No cost to you. Totally complimentary. One of the more important phone calls you can make, certainly today. 833-707-3030. Back with more with Brian and Mark right after this on Safer Retirement Radio.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833 833-707-3030. Again, that's 833-707-3030.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. I'm Mark Elliott. Again, the website, DeckerRetirementPlanning.com. Find out more about Brian and the team, where the offices are. All that information is on the website. You can always call with questions, 833-707-3030. I'm Mark Elliott. Glad you are with us. We're talking about not a topic that we like to think about, but certainly something we better have a plan for, and that is the loss of a spouse. So, Brian, you guys were talking about Social Security and the ramifications, and then Mark was talking about, boy, if you have things scattered all over the place and your spouse doesn't really know where it all is, it really could be a headache. Where are you going now on this topic?
We're going to keep hitting different topics here. When you lose a spouse, there's a cottage industry that when they see the obituary in the paper, they will track you down and they will make up invoices and say that you owe them for maintenance, yard work, electrical, all kinds of stuff. Don't assume you owe them. Review those debts. Be careful not to just pay, but to make sure that that's legit. Mark, let's go in this direction. So health insurance transitions, I think we covered that. But let's talk about Medicare and supplemental plans. So if someone is taking Medicare, when you stop Social Security right away, you've also got to notify Medicare and consider the changes that are made there. Mark, will you hit that one?
Yeah. So when it comes to Medicare, obviously the different plans are beneficial to different groups of people, right? Married people are going to have benefits for a couple versus a single person. You want to make sure that you're not overpaying for benefits that you don't really need. Like, let's say you're a surviving wife. Well, you don't need a policy that provides prostate cancer screening. And you just want to make sure that you're reviewing the medical coverage that you have. And also, I'd like to bring this up as well. When it comes to long-term care insurance too, is another one. A surviving spouse is at a higher likelihood of needing somebody to come in and take care of them in the house. If they don't have somebody that they're married to that can help them with their daily activities, you're going to have to hire somebody to do that. So now the discussion around long-term care becomes really important. And how are we going to have you taken care of if something were to happen to you where you're not able to take care of yourself?
So, Mark, when it comes to taxes, they've got a benefit that is now changed. So they have between date of death and 12/31 of that tax year to take advantage of married filing jointly status, because the next year they're going to go to a single status. And for most people, that means that their tax rates are going to go higher. So what are some of the things that need to be done to take advantage of the few remaining months or sometimes weeks of married filing jointly?
Right. So here, if you're in a situation where you can do some tax planning and you know that there's going to be some arbitrage from where you currently are to where you will be in the coming years, one that we look at in situations like this is doing the Roth conversion. So if we're anticipating that you're currently in a lower effective tax rate today, but then 2-3 years from now, you're going to be in a higher effective tax rate because you're going to be filing as a single filer, then we might as well do some Roth conversions in your pre-tax IRA or your 401k as a way to, get the tax growing tax-free rather than tax-deferred. Another thing you want to consider is something called a step-up in basis. So this is for your non-retirement assets. Think your house, think your joint investment account, anything that you own outside of a retirement account that has appreciated in value. You're able to take advantage of an increase in the basis of that asset, and that allows you the ability to sell that asset without incurring capital gains later on. So upon the death of one of your spouses, you're able to basically reset the basis for the asset and eliminate any capital gains that you might be owed on that appreciated value of the asset.
Mark, this is important enough. Give an example.
So, for example, here in the Pacific Northwest, we run into this with real estate a lot. Let's say a husband and wife bought a house here in downtown Bellevue back in 1995, and they paid $300,000 for it, right? But now, today, that house is worth maybe $2.5 million. If they were to sell it, then they owe capital gains on millions of dollars. But if one of them were to pass away, then what they need to do is they need to find an appraiser. They need to get a appraised value for the house today, and the surviving spouse could then turn around. Maybe they want to sell and move to another state, or they want to sell and move into a condo. They don't want to do the yard work and the repair and the maintenance that comes along with owning the house anymore. They just want something very simple to live in. Well, they can sell that house without paying taxes on all the appreciated value of the house. So that's a really valuable tool for the surviving spouse to take advantage of. Brian, this is a really important one here. When we're talking about beneficiaries, we're talking about on your bank account, your investment accounts, your retirement accounts, your estate documents. This could be your trust is a really important one. Maybe if you have some kind of an LLC structure or any kind of an organized structure, all of those are going to need to be updated because the financial institutions are going to need to have proof that somebody has passed away. So that's why Brian was mentioning you want to get multiple copies of your deceased spouse's death certificates, because all these financial institutions are going to need verification that a beneficiary has passed away. So what you do is, let's say we work with Fidelity and you have some life insurance policies. You're going to contact the custodian and let them know that you need to update the beneficiary. Usually that's a form, or it can sometimes be done online. It's a really simple process. We work with all of our clients to help review all of the accounts that we're working with them on and make sure that we have updated beneficiaries on file. And then from there, we go and we look at your will and your trust. And we want to make sure that these documents are still in line with your goals and how you want your estate plan to be handled. One thing that we always caution our clients on is something in the industry, we call it widow's brain, where people have a tendency to make decisions in the first few months or even a year or two into being a widow or a widower that are more emotional in nature and maybe not logical. So working with a financial advisor and a professional who's gone through these types of situations before can really help with clearing the fog when it comes to these types of situations and getting some good sound advice.
So again, if you'd like to sit down with the team at Decker Retirement and talk about all of this, there's a lot on your plate. Certainly when you lose a spouse, there's the emotional part of that. And then, of course, it's the government saying, hey, boy, we really feel bad that you lost your spouse, but you're going to file your taxes as a single person now, and it's going to cost you a lot more in tax money, and your bills have not dropped in half. So there's a lot of things that the team at Decker Retirement are here to help walk you through. You don't have to make a lot of big decisions when you have an emotional stress like that. 833-707-3030, again, is the number to chat with the team at Decker Retirement Planning, 833-707-3030. Back with more with Brian and Marc right after this on Safer Retirement Radio.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Remember that first paycheck when you started working all those years ago? You looked at the net amount and thought, whoa, what happened here? Ah, the joy of taxes. It could be this way with your retirement accounts. You know how much you've saved, but if you haven't planned for Uncle Sam, you could come up short in retirement. With tax laws constantly changing, there's a lot you need to know to make sure you're not paying more than your fair share. Financial advisor Brian Decker and the Decker Retirement Planning Team can help you create a plan that shows you how taxes could affect you now and in the future. Set up your tax strategy session with Brian and the team at Decker Retirement Planning now. Call 833-707-3030. That's 833-707-3030. Make sure you know how these changes could affect you so you can avoid some of those whoa moments in retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can always go to the website, deckerretirementplanning.com, learn more about Brian and Marc and the team and where the offices are. But you can also go there to find out more information about some of the retirement questions you might have. Under the heading of Safer Retirement Education, there are 12 things you can download, including Brian's book on retirement, the Decker Approach book. There's also a 3 Principles of Retirement book there. There's a checklist challenge. I think there's like 35 boxes to check. There's a sample income plan. Those are just 4 of the 12 things you can download on the website, deckerretirementplanning.com. Under the heading of Safer Retirement Education, there's no cost to grab whatever you want. It's there for your information. So it's a great opportunity, I think, if you're trying to learn about certain areas, to go check it out. See if there's something you want to grab a hold of and learn a little bit more about, and then maybe have questions you want to talk with the team. Just give them a call. There's no cost, 833-707-3030. All right, we're talking today about a traumatic situation, really, losing the spouse that you've been married to for maybe 20, 30, 40, even 50 years, and all the ramifications of that. Because, Brian, at the end of the day, when you lose a spouse, your taxes might go up. You have less income, but taxes go up, and you're dealing with the emotional trauma of losing a spouse. There's just a lot of whammies when it comes to losing a spouse, isn't there?
It's really rough. We tell our clients that we are the second phone call when you lose a spouse. The first phone call is to the children, and we step in and we really help guide our clients through this process. But we're just reviewing from our playbook the important things that need to be done. These are small ones here, Mark. Updating your own estate plan, relook and review your will, your trust, your power of attorney, and healthcare directed. Are there any changes to be made there? Change what still lists your spouse. So driver's license, emergency contacts. Go into the utilities. You've got to change the name there. HOA, subscriptions, phone plans. Make sure that you're updating that deceased spouse should no longer be on those things. And here's a biggie, Mark. I think this is very important. Delay big decisions. When you're hit with something this hard emotionally, don't respond to anyone that says that you've got to make important decisions right now. Delay big decisions. Don't sell the house. Don't relocate. Don't give away money. You don't want to be alone much during this grieving period. Here, Mark, I know I want you to jump in on this, but I'll just finish with this. If someone pressures you to move fast or invest money or just sign this or make emotional decisions, just give them the cross of Dracula. Tell them to go away and that you've got plenty of time to do.
So when we're talking about working with a financial advisor, what value do we have on our side, both before and after the passing of a spouse? We have very intentional conversations with our clients. Before a spouse passes, this is where we can take a lot of action to prepare for the eventual passing. I mean, we're all going to pass away eventually. So we can have conversations around estate planning and around gifting strategies and around the transition of assets after we've deceased. That's really where setting up a trust becomes really important. What a lot of attorneys will do is they will work with a couple to set up a trust, and then when one of the spouses pass away, the surviving spouse doesn't really even think about it, but they need to go back to that attorney and they need to implement some of the strategies that are written into the trust. For example, here in Washington State, we have a very low estate tax threshold of $3 million per person. So if one spouse passes away, the surviving spouse doesn't automatically get to take advantage of the deceased spouse's $3 million exclusion. But there's language inside your trust that allows you to take advantage of that, but you have to take advantage of it when the first spouse passes away. So if you're just hoping that your trust just magically takes care of it, you might be really disappointed later on, years down the road, to find out that now your estate is worth way more than it's supposed to be. And if you were to pass away, you're going to end up owing hundreds of thousands of dollars in taxes that you don't need to pay. But by working with a financial advisor and reviewing your trust documents, this is where we key in on those types of situations. We key in on that language in your trust, and we can work with you and your attorney to make sure that we're implementing the strategies that are already outlined in the trust. You know, identifying power of attorney is going to be really important there too. When it comes to your power of attorney, usually what we do is we name our spouse as our primary power of attorney, and we don't give it much thought after that. But when it comes to having somebody who can do administrative work for you, you're going to want them to be nearby. So geographically, I recommend them be nearby so they can take care of administrative things on your behalf or sign documents, go to the bank with you, and maybe even write checks for you if you need to have checks written, go to the hospital with you. So having your medical power of attorney is also really important to update. All of these things you need to kind of logistically think through like who really is the right person to be my power of attorney, not just from a trust perspective, but from an ability perspective. Are they able to serve in that capacity? So that's really important to think about. Like I said, working with a professional in this situation is really important, because they're going to set you up for, the next maybe decade to live life without a spouse. And you want that to be as easy as possible from a administrative and financial perspective. So I wanted to quickly touch on, what about the portfolio? There's a big difference between how a husband and wife might invest their money versus just how a spouse as a single person might invest their money. I run into this all the time, where one spouse is a lot more aggressive than the other spouse tends to be. And if one of the spouses passes away, it's really important to review the portfolio, to take a look at how everything's invested, and make sure that it's in line with the risk tolerance and the investment strategy and philosophy of the surviving spouse. So usually what we'll do is have a conversation with the surviving spouse and talk them through about how their portfolio is currently allocated, maybe revisit the risk tolerance questionnaire, or revisit the amount of liquidity that their plan has, or the amount of equity that their plan has, or the amount of, maybe alternative investments that a portfolio has, and just make sure that it is in line with what this spouse is wanting in their portfolio. So that's a very important conversation. The last thing you want is to assume that your portfolio is invested how you want it to be invested, when in reality, it might be way more conservative than you want it to be, or it might be way more aggressive than you want it to be. Or your deceased spouse might have had some contingency plans that he knew about or she knew about that didn't get relayed to you. And now all of a sudden you're in a situation where you don't know the whole story, or you don't know what the whole picture looks like. So sitting down with a financial advisor, review the portfolio, and it gives you an opportunity to really clean up a lot of things, whether that's resetting the cost basis, reviewing the beneficiaries of your portfolio, reviewing your trust, reviewing the equity that you have in your real estate. All of these topics should be something to consider. Long-term care, again, is something to consider when a spouse passes away. I understand that it is a very emotional time when a spouse passes away, right? This is your best friend. This is somebody that you've been with for years, and now you're walking this journey alone without them. So make sure that you're surrounding yourself with professionals who have been through this before, who know what they're doing, who know how all of the moving pieces work, and reviewing the portfolio for accuracy, for clarity, for focus, consolidation of accounts. All of those things really just help to put you in a much better position going forward.
So there's a lot of things that Brian and Mark talked about today, and the loss of a spouse is certainly, the emotional side is incredibly difficult. The problem is your bills don't get cut in half, and the government decides that now they're going to tax you much, much more. So you're going to have less income, and you're going to have more taxes. So it's kind of a whammy there. You're going to lose the lower of 2 Social Securities, keep the higher, lose the lower. You might lose some or all of a pension. So just a lot of things to think about. And and you want to think about this before something happens, not obviously when it happens. You'd like to do some pre-planning in this area. And the team at Decker Retirement is certainly here for you to help you do just that, because it is about you. It is about your loved ones. How do we plan for all of that? 833-707-3030 is the number. Again, no cost to you, no obligation whatsoever. 833-707-3030. And if you leave a mess when you go, that's, I don't think, the way you want to be remembered. You want to take care of your loved ones, so you don't want to leave them a mess. So you do have that opportunity. just by talking with Brian, Mark, and the team at Decker Retirement. 833-707-3030. 833-707-3030. When we come back on Safer Retirement Radio, Brian J. Decker and Marc Knauss of Decker Retirement, they've got another topic to get into in our final segment. Stay with us. We're back right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Again, you can go to the website to learn more, DeckerRetirementPlanning.com. There is the heading of Safer Retirement Education. There's 12 things you can download. Brian's book on retirement, the 3 Principles of Retirement book, a checklist challenge, a sample income plan, or just 4 of the 12 things you can download. It's all there for your information. If you get any or all, and then you got some questions, or you just have some questions right now thinking about, boy, I think we've done the right things. I think we should be able to retire and be okay, but you don't know, call the team. That's what they're here for. 833-707-3030, 833-707-3030. All right, final segment, Brian. Where are you and Mark going?
Okay, well, let's keep going down the tax side. When it comes to this is one of my favorite, Mark, and you just had this last week. If you have a rental income stream, can you really make it tax-free?
This is really an interesting question. You run into this a lot around here, the Pacific Northwest. I have talked to so many clients that have made their wealth in investment real estate. And you get to the point where this income that's coming to you from your rental property gets to be very significant. And the taxes associated with that rental income drive you into a higher tax bracket. So now all of a sudden you have Social Security coming to you, you have your IRA distributions and portfolio income coming to you, and you also have rental income coming to you. Well, what strategies are out there that are available to investors that can reduce the income taxes associated with rentals? When you buy investment property, there's something called a depreciation schedule. So take, for example, you buy a rental property. The government allows you to depreciate that property over 27 and a half years. So a little bit every year you're able to depreciate, and you can take that depreciation and use it to offset your taxable income. Well, that's nice, but 27 and a half years, you're really not getting a whole lot of depreciation credits to offset your income. So there's a few different strategies you can consider when looking at this. One of them is something called a cost segregation strategy. So a cost segregation strategy, what you do is you hire a firm, usually it's about $2,500 or a few $1,000s to come in and do an analysis of your investment property. So they look at the carpets, they look at the walls, they look at the countertops, they look at the brick fireplace, they look at the roof, they look at the deck, they look at the windows, every component of the house, and they give each one of those components a line item depreciation schedule. So instead of depreciating the entire house over 27 and a half years, now you're able to accelerate the depreciation schedule down to about 10 years. So you get much larger depreciation amounts every year because of the accelerated depreciation schedule. But here's where you got to watch out. After 10 years, or when that depreciation schedule runs out, now all of a sudden you have this tidal wave of taxable income coming to you that you no longer have depreciation that you can use to offset that. So that's why investors are frequently doing what's called a 1031 exchange. So a 1031 exchange allows you to sell your property and move the value of that property into a new investment property and defer the taxes. So you don't have to pay the deferred depreciation. You don't have to pay the capital gains associated with the investment property. You're pushing all of those. You're kicking the can down the road. So once you do the 1031 exchange into a new property, then you do another cost segregation study on that property, and it allows you to start the process over again with a new property, most likely a bigger one. If you're deferring the growth and now you're selling that and moving into a larger property, now you've got the same income coming in or more income coming in, and it's also tax-free. So a very powerful tax saving strategy. And if you look at the tax benefits in the OBBB that just made its way through Congress, the one big beautiful bill, you'll notice that there is a 100% depreciation allowance for rental properties. And you can actually blend the 100% depreciation allowance with a cost segregation depreciation. So you can really target your depreciation schedule both between a large lump sum depreciation in year one and smooth it out over the next 5 to 10 years with a cost segregation study.
And that creates an income stream on your rental real estate properties that is tax-free with accelerated depreciation. Okay, that's one of my favorites. Mark, I'm going to take this one. This is a dynasty trust. This is where you've got your 2 or 3 children that say, Mom, Dad, we're doing great. We don't need any help. Go ahead. Any money you've got, you spend it. And you think, geez, what about the grandkids? Well, if you want to send your money down to the grandkids, you're subjecting yourself to a generation skipping tax of 48%. And the reason is because you're preventing a whole generation of taxation on those funds. So the IRS hits it pretty hard. But there's a generation skipping trust called a dynasty trust where you can create the trust while you're alive. And let's say you've got 3 children, you can have the dynasty trust created while you're alive and listed as a beneficiary so that when you pass away, the dynasty trust can take a portion of your estate and you, on a blank chalkboard, you list how you want that trust to distribute. You distribute based on whatever is important to you. Here's what's typical. So now this dynasty trust is perpetual and it's per stirpes. It's bloodline only. So when your children and grandchildren and their children and their children, your legacy, if there's a divorce, that stays in your bloodline. These funds cannot be split out to another person. It stays in their bloodline. And then what you incent is responsible behavior as you see it. So typically a percentage of the trust goes to your grandchildren or their children if they go to college, in their first marriage, down payment on a first house, so that if they don't go to college and they don't marry and don't buy a house, they don't get any of the trust. So you're able to incent the behaviors that you feel are responsible behaviors. That's called a dynasty trust. That's something that we help clients put together, especially when their children are doing financially very, very well. It allows you to cross a generation, not be hit by that 48% tax, and benefit your legacy. Mark, we've got a couple more minutes. Let's hit the GRAT.
Sure. So this is a strategy for ultra high net worth clients. At the federal level, every American is allowed $13 million in gift or estate tax, estate value over their lifetime. But there are a number of clients who worry that their lifetime exemption is going to be over that amount. And in order to avoid being over that amount, you can utilize a trust structure that allows you to structure a loan between a trust rather than a gift to a trust. So let's say, for example, I have $15 million in my portfolio between real estate, my portfolio, my primary residence, and I want to move some of that out of my estate, but I don't want to use my lifetime gift exemption. Well, I can structure a loan between a grantor retained annuity trust and myself where I transfer assets to this trust and it pays me income as a loan payment every year for the rest of my life while allowing me to move this large asset. Let's say I've got a $4 million property. I can move that property outside of my estate and the trust pays me a loan payment every year for the rest of my life until I pass away. So that's a very powerful tax planning strategy to move assets outside of your estate without taking up your lifetime exemption. Another very common strategy out there, and I see this more and more often, is utilizing an irrevocable trust. So an irrevocable trust is a trust that is outside of your control, but still for your benefit. For clients who are going to be over the Washington state estate tax threshold, they can utilize an irrevocable trust and purchase a life insurance policy inside of it. Why would you do that? So essentially, it's a wealth replacement strategy. When husband and wife pass away, the life insurance policy pays out to this irrevocable trust, and it creates a cash infusion for the beneficiaries that they can use to pay estate taxes, to pay capital gains taxes, to pay any foreseen expenses that might be coming up down the road without forcing the children to fire sale family assets. You don't have to sell the vacation home. You don't have to sell the investment property. You don't have to sell the primary home in order to come up with the cash needed to cover expenses related to passing. So that's called an irrevocable life insurance trust. It's very common for clients who have significant wealth and want to find ways to prepare for estate taxes down the road.
As always, on Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning, and today with Marc Knauss. A lot of ground covered. Any questions you have, you would like to learn more about anything they were talking about, or something that else is concerning you about upcoming retirement, or you're retired already and you have some concerns. 833-707-3030 is the number. Again, no cost to you. 833-707-3030. Might be the most important phone call you make. No cost to you. 833-707-3030. Brian, Mark, appreciate the time. Enjoy the rest of the weekend.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Remember that first paycheck when you started working all those years ago? You looked at the net amount and thought, whoa, what happened here? Ah, the joy of taxes. It could be this way with your retirement accounts. You know how much you've saved, but if you haven't planned for Uncle Sam, you could come up short in retirement. With tax laws constantly changing, there's a lot you need to know to make sure you're not paying more than your fair share. Financial advisor Brian Decker and the Decker Retirement Planning Team can help you create a plan that shows you how taxes could affect you now and in the future. Set up your tax strategy session with Brian and the team at Decker Retirement Planning now. Call 833-707-3030. That's 833-707-3030. Make sure you know how these changes could affect you so you can avoid some of those whoa moments in retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.